Today, we are taking a massive leap forward in how you view market structure. Because the fundamental challenge for anyone looking at a price chart is this. It often looks, random, it looks noisy, chaotic,
Totally.
a truly confusing array of movements. But that's really just an illusion. The market is, in fact, a visual, measurable, and I'd say highly predictable record of human psychology. It's like a playbook for risk that just repeats itself over and over.
Exactly. And the mission today, specifically tailored for you, is to move way past that introductory stage. We are not just confirming that a pattern like, say, Head and Shoulders exists.
Right.
We're diving into the full technical arsenal used by professional institutional traders, the ones who grade these patterns like a professor grades an exam.
Yeah.
We're really setting the 2026 standard for chart pattern mastery here.
And that involves a level of precision and context that, let's be honest, moves far beyond what most retail traders are even looking at.
It really does.
So we've been provided with a truly comprehensive guide on advanced chart patterns. And it dissects not just the shapes, but the math, the market psychology, the hard statistical performance data.
And crucially, the real-world execution strategies.
Yeah.
The stuff used by desks that move serious capital.
So this isn't just pattern recognition, this is the foundation of pattern mastery.
Our goal is to extract those essential elements that separate the pros, the consistent winners, from the amateurs. And based on the analysis in this material, we can distill it down to 3 levels of mastery you absolutely have to achieve to be competitive.
Okay, let's unpack this. What are those 3 essential elements? What defines that professional approach?
Well, first, it's pattern recognition precision.
Precision.
This means you cannot rely on hindsight or wait for a pattern to be fully formed to confirm it. You need the ability to identify an ascending triangle, for instance, not after the breakout, but at the 70% completion mark.
So you're positioning yourself before the market has definitively chosen a direction.
Exactly. It's about being anticipatory, not reactive.
That immediately raises a practical question, though. How do we build the confidence to act when a pattern is only 70% complete? I mean, it sounds like you're asking us to fight that natural instinct, to wait for absolute certainty.
And you fight that instinct with objective rules, which leads us to the second element, contextual analysis.
Okay.
This is recognizing that the same chart pattern, let's say a double top, has a vastly different statistical success rate if it forms in a strong established uptrend versus if it forms following, multi-year low.
So location, location, location. The environment matters more than the shape itself.
Way more. You have to grade the pattern based on the trend, the time frame, and the confluence of other objective factors.
And the third element, I'm sensing this is the hardest part.
It is. It's pure execution discipline. This means having the patience to wait for every single criteria of your setup, especially the volume rules we'll detail, to be met before you even think about touching the entry button.
And then?
Then, once those criteria are met, you need the courage to act decisively. And you need the unwavering discipline to manage that trade through its entire life cycle.
So sticking to the stop loss, sticking to the profit target.
Sticking to the plan, without letting fear or greed interfere. Look, the first 2 elements give you the edge. This third one, discipline, is what allows you to realize that edge consistently.
Let's start with the why behind these formations. It's so easy to get lost in the lines and the geometry, right? To think of them as just abstract drawings.
Yeah.
But what's fascinating here is that chart patterns are not geometric shapes. They are the visual, quantifiable manifestations of recurring human behavioral patterns. It's the market's psychological language laid bare.
They tell a story, a measurable story. Every pattern, whether it's a flag or a Head and Shoulders, is a miniature battlefield. It's showing the forces of accumulation and distribution at play.
And if you can understand that story, who's winning and why, you understand the pattern's reliability.
And we can map every major chart pattern back to 4 sequential phases of market behavior. It's a predictable cycle.
Okay, let's walk through that. The anatomy of pattern formation. How does the market tell this internal story through price and volume?
Well, it all begins with the accumulation phase.
The quiet part.
The very quiet part. This is the initial period where the smart money, so institutional investors, large funds, professional traders, they're quietly building their positions. They're using limit orders, patiently buying the dips or selling the rallies within a very tight range.
And the retail trader at this point is where?
Often absent. Or they're selling out of frustration that the price just isn't moving. Visually, what you see is price consolidation, tight trading ranges, and most importantly, volume just contracts. it dries up.
And this phase creates the base of the pattern.
It creates the base or the consolidation channel of a continuation pattern. It's the groundwork being laid before the big move.
The calm before the storm.
Exactly. Then you get the markup or markdown phase. Once those institutional positions are fully established, their concentrated buying or selling pressure finally moves the price, directionally and powerfully.
And that creates the initial strong trend leg, like the flagpole in a flag pattern.
That's the one.
Yeah.
And this action precedes the main pattern formation itself.
And then the market takes a necessary breather. That's where the actual pattern, the consolidation, begins to form.
And that's the distribution or consolidation phase. Here you get profit taking, you get renewed indecision, and that creates the structured pause we recognize. The triangles, the flags, the rectangles. Price just oscillates as the early participants, the smart money, start to sell their profits to the latecomers.
A period of temporary equilibrium, a testing of conviction.
You got it. And the tighter that pattern gets, the greater the pressure that's building inside it.
Until finally that psychological tension just breaks decisively.
Which is the resolution phase, the breakout. The accumulated pressure is released, and one side, the bulls or the bears, overwhelms the other. This movement triggers a cascade of stop losses from those caught on the wrong side.
And it forces momentum followers to jump in aggressively.
Right, and that collective action creates the dramatic, predicted movement, the measured move that we can actually quantify.
This brings us to the core reason why these patterns work. It's not mystical, it's not prophetic, it's just collective human and algorithmic action. The self-fulfilling prophecy.
It's not magic at all. It's millions of traders and their sophisticated algorithms all recognizing the exact same signal and acting simultaneously on predefined risk parameters.
Right.
Take a textbook, head and shoulders forming on a major index. Let's say the critical neckline is precisely at 4,000. It's not just that the chart predicts a fall.
It's that thousands of risk managers have mandated placing sell stops just below 4,000.
Exactly. And algorithmic systems are programmed to trigger massive short positions at that break. Anyone holding long below 4,000 is forced to liquidate.
And all that combined action, the stops getting hit, the new shorts entering, the forced selling, that collective synchronized action creates the very price movement the pattern predicted.
Understanding that.
Yeah.
That the pattern is a map of synchronized risk management that removes the mystery and replaces it with quantifiable behavioral psychology.
And that's the professional perspective, a perspective that requires a highly rigorous pattern classification system.
Yes, we have to categorize patterns not just by their shape, but by their function, their timing, and most critically, their statistical reliability.
Let's start with function, the directional bias. Reversal, continuation, and bilateral.
So reversal patterns, they clearly signal a change in the prevailing trend. The big ones are head and shoulders, double tops, rounding bottoms. They indicate exhaustion.
Okay.
Continuation patterns signal a temporary pause, followed by the resumption of the existing trend. Those are your high-velocity flags, pennants, and directional triangles.
And
Bilateral patterns, like symmetrical triangles or rectangles, they show pure indecision. They can break in either direction. It just depends on which side wins the consolidation battle.
Then we have the reliability tiers. This is where we start grading the quality before we even look at volume, right?
Yes, this helps us prioritize where to spend our capital. Tier 1 patterns have the highest historical success rates, typically 70 to 80%. These are your A-grade setups, like a confirmed H&S or a well-formed ascending triangle that respects the trend.
And Tier 2?
Tier 2 is a little riskier, maybe 60 to 70% success. That covers your textbook double tops or clear flags. And Tier 3 is only 50 to 60%. Barely a coin flip.
Things like symmetrical triangles or broad rectangles.
Right, where the direction is highly uncertain and you absolutely need heavy volume confirmation to even consider it.
And of course, reliability depends heavily on the time frame. A pattern on a 15-minute chart just doesn't carry the same weight as one on a weekly.
Not even close. The higher the time frame, the higher the conviction. It's because a greater number of participants, especially large institutions, are involved in monitoring those levels.
So major patterns on weekly or monthly charts.
Those are rare, maybe only a few times a year, but they often have an 80+% success rate. Intermediate patterns on the daily or 4-hour are more frequent, maybe 65 to 75% success.
But the minor patterns, 1 hour and below.
High frequency, high noise. You're looking at 50 to 60% success. If you only focus on those, you're almost trading randomly. The lesson is simple. Conviction scales with time.
This brings us to what might be the single most critical differentiator for professional pattern trading, the part that separates the Tier 1 patterns from the coin flips.
I know where you're going.
The critical role of volume, the pattern's heartbeat.
This cannot be overstated. Volume reveals institutional conviction, or, more importantly, the lack thereof. If a pattern forms on low volume and breaks out on low volume, it's highly suspect.
And the stats back this up.
The statistical reality from our sources is just brutally clear. Patterns with the proper volume characteristics, meaning institutional participation is confirmed, they succeed 73% of the time.
Okay, 73%. And without volume confirmation?
They succeed only 52% of the time.
Wow. You literally drop over 20 percentage points in probability by ignoring this one factor. That's the difference between a high-edge setup and just gambling.
It is the difference between an A-grade and a C-grade setup. So we need to detail the 4 specific volume requirements, the rules for reliability that you have to check against every single pattern you trade.
All right. What should we be looking for during that consolidation phase?
Okay, rule 1. During pattern formation, volume should decline quietly and smoothly.
Decline?
Yes. This contraction confirms that the price oscillation is a quiet accumulation or distribution phase, not some chaotic battle. If you have this high, choppy volume during consolidation, that suggests major indecision and makes the setup unreliable.
Okay, so contraction during consolidation confirms the big players are quietly positioning. What happens when the pattern resolves?
Rule 2. At the breakout, volume must surge. I'm talking 50 to 100% or more above the average volume of the consolidation phase.
That's the confirmation.
It's the confirmation that institutional money has piled in, that the move is genuine. Without that dramatic surge, you have to assume the breakout is weak and likely to fail.
That surge validates the move. But how does a retail trader confirm a 50 to 100% volume surge in the first few seconds of a breakout without running into massive slippage? Do we have to wait for the bar to close?
You do. And that's where the discipline comes in. Yes, you wait for the bar to close. The professional definition of a true breakout requires 2 things: a decisive close outside the pattern boundary, and a closing volume that confirms that surge.
So you sacrifice the first few ticks of movement.
You sacrifice a slightly worse entry price for a 15 to 20% higher probability of success. It's a trade-off professional traders make every single time.
That's a really helpful distinction. What about follow-through?
Rule 3, continuation. After the breakout candle, volume should remain elevated, or at least above average, for a minimum of 2 to 3 more bars. You want to see genuine follow-through conviction. It can't be a one-candle wonder that immediately reverses.
Okay. And finally, Rule 4 is about the retest. This one often trips up novice traders who panic when the price pulls back.
Right. So, on the retest of the broken level, when price pulls back to the neckline or the pattern boundary volume must be significantly lower.
Lower.
Much lower. This indicates that the selling pressure causing the pullback is exhausted, and the level that was just broken is now firmly established as new support or resistance.
Yeah.
If the retest happens on high volume, it signals a huge risk the pattern is failing.
So these 4 rules,
Yeah.
they elevate technical analysis from just simple line drawing to the objective measurement of market conviction.
That's it. That is the 2026 standard.
Let's move into the patterns themselves, starting with the undisputed leader among reversals, the head and shoulders, HNS. When it's properly confirmed, the source material credits this Tier 1 setup with a 78% historical success rate.
It's the king because its structure perfectly visualizes buyer exhaustion and the sequential capitulation of momentum. Let's look at the psychology embedded in its 4 key components: the left shoulder, the head, the right shoulder, and the neckline.
Okay, so the left shoulder is a strong rally, usually on high volume, which establishes a high point. Then it declines as people take profits. So far, that's just normal, healthy trend behavior.
Right. But the head is where the critical warning sign appears. Price rallies again above the left shoulder to a new high, and it looks like it's confirming the uptrend. But this rally to the head often happens on noticeably lower volume than the preceding left shoulder rally. That is the first alarm bell. The bulls push the price higher, but with less institutional commitment.
So the market has tried to push to a new extreme, but found no real conviction there. Something is changing.
Absolutely. Then comes the defining failure: the right shoulder. Price rallies again, one last attempt by the bulls. However, this rally fails decisively to even reach the head's height. This lower high is critical. It confirms momentum has weakened, and crucially, the volume on this right shoulder rally should be the lowest of all three peaks.
And the neckline just connects the two troughs between those shoulders and the head. That's the critical make or break support level.
Yes, and the final psychological shift happens at that breakdown. When the right shoulder fails and price breaks the neckline, the remaining bulls capitulate. Stops are triggered, short sellers jump in, and you get that massive momentum for the measured move.
To trade this like a professional, we have to use the quality grading system.
Yeah.
We can't just see the shape. We have to grade it against hard rules.
That's the core of the 2026 standard. We're looking for technical perfection. First, near perfect symmetry. The shoulders should be within 5 to 10% of each other in height and duration. The head has to be clearly higher, minimum 8 to 10%.
But the most critical element for grading is that volume trend.
It's non-negotiable for an A-grade setup. A declining volume profile from left shoulder to head to right shoulder.
So if we have that textbook structure and the perfect volume, what constitutes that A-grade setup?
An A-grade H&S has near perfect symmetry, that textbook declining volume, a confirmed breakout on 100+% volume surge, and ideally it forms at a major resistance level, like a multi-year high.
And a setup like that.
The source suggests an 85% success probability. If your volume is inconsistent, you drop to a C grade at 60%. And if there's no volume confirmation on the breakout, you have to skip it entirely.
Okay, on to execution. Trading the H&S requires iron discipline. What's the professional entry strategy once that neckline is broken?
The conservative entry is to wait for the pullback. You wait for the decisive candle close below the neckline, making sure it's not a fake out. Then you wait for price to rally back up and retest that broken neckline, which now acts as resistance. You enter short on the rejection of that retest.
And the aggressive trader enters right on the breakout candle's close. But regardless of entry, stop-loss placement is the critical risk management lesson here. How do we place it using the structure?
Stops have to be structure-based, never arbitrary. The conservative stop-loss goes above the right shoulder high, plus a small buffer, maybe 1 or 2%, or an ATR buffer.
Just quickly, for those less familiar, what is the ATR buffer?
Sure. ATR is average true range. It's just a measure of market volatility. So an ATR buffer means you calculate the current volatility, say the average daily range is $1, and you place your stop $1 or $2 above the right shoulder high. It just accounts for market noise.
So it saves you from getting chopped out prematurely.
Exactly. And the key structural decision is placing that stop above the right shoulder, not the head.
Why is that?
Because the right shoulder represents the point where the bears establish definitive control. If the price rallies back above the right shoulder, the pattern has failed, even if it hasn't hit the head. Our case study later shows a trader who saved over $2 a share on risk by doing this.
And the profit target has to be quantifiable.
It's a measured move. You calculate the vertical distance from the head's peak down to the neckline. Then you project that exact distance downward from the breakout point. It's the minimum expected movement.
And what about the concept of the failed H&S? This sounds like a trap, but the source says it can be a powerful contrarian signal.
It's the ultimate reversal trap. When you get a perfect H&S setup that breaks the neckline but then immediately reverses, closes back above that neckline, and holds, it signals that the initial breakdown trapped all the aggressive short sellers.
And they're forced to cover.
They're forced to buy back their shorts to limit losses, which creates this powerful, explosive short covering rally in the opposite direction. This failed reversal setup is surprisingly reliable, around 70% success, because it feeds on trapped institutional emotion.
Let's move on to another high probability reversal, double tops and double bottoms. They seem simpler, but they hold significant power. Again, only when volume confirms them.
A double top represents two decisive failures by buyers to break a key resistance level. For a good one, we need specific rules. The two peaks must be almost identical, ideally within 3 to 5% of each other.
And timing matters here too, right? Especially on daily charts.
Precisely. The optimal time between those peaks is 4 to 8 weeks on a daily chart. That time gap is essential. It allows enough time for sentiment to genuinely shift. If the peaks are too close, it's often just noise, too far apart, and the underlying market conditions may have changed entirely.
And the critical divergence, just like the H&S, has to be in the volume profile for that second peak.
Absolutely crucial. The first peak usually forms on higher volume, strong conviction. But the second peak must form on significantly lower volume. It signals weakening conviction. Without that divergence, you're looking at a 54% success rate. It's a coin flip.
And then the breakdown below the trough needs a big volume surge to confirm.
50+% minimum.
Now, there's an interesting advanced classification based on the shape of the peaks.
The Adam and Eve concepts. It differentiates between sharp and rounded rejections. Adam and Adam tops have sharp V-shaped peaks. They're highly reliable, around 75% success, because that V shape implies a decisive, rapid rejection.
And Eve and Eve?
Big Eve tops have rounded peaks. They indicate more gradual distribution and indecision, so reliability is lower, maybe 62%.
Finally, triple tops and bottoms. Intuitively, you might think 3 touches of resistance means the level is getting worn out, but the data says the opposite.
That's one of those counterintuitive nuggets that separates knowledge from intuition. 3 failed attempts to break a level demonstrates incredibly strong institutional conviction at that price. The failure to push through often leads to a more violent, more reliable reversal.
And the success rate.
The source suggests triple tops and bottoms boast an 80% success rate. They carry stronger conviction than their double top counterparts.
All right, let's shift our focus now from reversal to continuation patterns. These setups are all about entering an existing established trend at a favorable, controlled price point after a healthy consolidation.
Right.
We'll start with ascending and descending triangles. These are directional signaling accumulation or distribution.
Exactly. The ascending triangle is the definitive bullish continuation pattern, and its underlying psychology is fascinating. You've got a flat top, a truly horizontal resistance line, where sellers are consistently defending a fixed price, and then a rising bottom, which is the ascending support line.
So sellers are defending $50, but buyers are getting more and more aggressive. They're willing to enter at 47, then 48, then 49, making progressively higher lows.
Precisely. The buyers are showing increasing demand, building immense pressure as the pattern converges. When they finally overwhelm the sellers at that fixed resistance, the release of energy is often explosive. That's the breakout.
What are the essential criteria for grading an A-grade ascending triangle?
Okay, first, it must form in an existing clear uptrend. It's a continuation pattern.
Right.
Second, the resistance has to be truly horizontal, max 2 to 3 degrees of slope. And third, critically, volume must contract significantly during the formation, confirming quiet accumulation.
When we go to trade it, the safest entry is still the pullback retest.
Yes. The safest approach is waiting for price to close above resistance on strong volume, then waiting for it to pull back and retest that broken level. You only enter when that former resistance proves itself as new support.
And the measured move is simple.
The height of the pattern, from resistance down to the first support touch, projected upward from the breakout.
Okay, here's where the advanced detail comes in, a critical differentiator for the 2026 standard. The apex rule. This is about timing and pattern efficiency.
This is a key technical truth. The tension in the pattern can only build for so long. The breakout should occur between 50 and 75% of the distance from the pattern start to the apex, the convergence point.
50 to 75%. Why that specific window? What happens if it breaks out too early or too late?
If it breaks out too early, say before 50%, it often means the consolidation hasn't fleshed out enough weak hands, and the move often fails. It becomes a false breakout.
And too late.
If it happens too late, beyond 75% completion, the reliability drops significantly. We're talking down to 54% success.
Why does breaking out late kill the setup's momentum?
Because the pattern has lost its energetic purpose. The price is essentially flatlining. The market participants who are going to enter have either already done it or they've lost interest. The pattern has just run out of time and energy. If it hits 80% completion, the professional advice is often just to abandon the setup entirely.
That's a great objective rule.
Yeah.
Moving on to one of the fastest, highest velocity continuation patterns, flags and pennants.
These are short, sharp consolidations after a powerful initial move. They just scream high velocity trend resumption. For a bull flag, you need 2 absolutely essential components, the flagpole and the flag.
The flagpole defines the intensity. It has to be a strong, almost vertical rally, say, a 20 to 40% gain over 1 to 3 weeks on high directional volume.
That's the initial power surge. And the flag itself is a short, rectangular consolidation that slopes slightly against the trend, so downward for a bull flag. Its defining characteristic, linking back to our volume rules, is that the volume must dramatically decline, often by 40 to 60% during this consolidation.
So that confirms it's just profit-taking, not a trend reversal.
Exactly. The flag itself should consolidate about 30 to 50% of the flagpole's range, and it has to be quick 1 to 4 weeks. If it takes too long, it loses its power.
And the trading strategy is all about joining that momentum on the breakout.
Yep. Stop loss goes just below the flag's lower boundary. Profit target is the length of the flagpole projected upward from the breakout point.
Statistically, flags are excellent. The source material notes bull flags have a 72% success rate overall.
Right, but if they form in a strong trend, say confirmed by an ADX reading above 25, that success rate jumps dramatically to 85%.
Can you just quickly define ADX for us?
Sure. ADX is the average directional index. It just measures trend strength. A reading over 25 confirms the market is clearly trending, not just ranging. So trading flags only when ADX confirms the trend is a massive edge booster.
And then there's the rare variant, the high tight flag. This one has a phenomenal 92% historical success rate.
This is reserved for truly explosive growth stocks. What makes it so successful is the sheer undeniable institutional demand. The flagpole is extremely strong, like a 90% or more gain in just 4 to 8 weeks.
Wow.
And the flag itself is incredibly tight, consolidating only 10 to 20% of that massive move. These setups signal intense, sustained demand and often lead to the most explosive continuation moves you'll ever see.
We've covered the patterns themselves, but the real edge, the key to getting those 80+% success rates, comes from layering confirmation. We need to move into multi-timeframe pattern analysis.
Yeah, absolutely. A single time frame pattern has a decent 65% success rate, which is okay. But when you align patterns across time frames, the probability jumps to 78% or more. This requires a disciplined 3-level time frame hierarchy: primary, intermediate, and execution.
Walk us through that professional hierarchy. How does the information flow?
Okay, the primary time frame, that's your weekly or monthly chart. This is where you define the major trend, your macro bias. It's the big picture.
Okay.
The intermediate time frame, daily or 4-hour, provides critical confirmation of that primary pattern's internal structure. It helps with earlier entry timing. And finally, the execution time frame, which is 1 hour or less, is where you find the precise trigger for your entry and stop placement.
Can you give us a concrete example of that alignment strategy?
Certainly. Imagine you see a large head and shoulders forming at the top of a 3-year rally on the weekly chart. That's your major reversal signal. That's your primary bias.
So you're now looking for shorts.
You're looking for shorts. As the right shoulder develops, you drop down to the daily chart and you see the price consolidating in a smaller bear flag. That's your intermediate confirmation that selling pressure is building.
So the daily bear flag is confirming the bearish momentum needed for the weekly H&S to bring.
Exactly. Then you drop further to the 4-hour chart and you spot a descending triangle forming inside that daily bear flag. You wait for that descending triangle to break its horizontal support. That is your execution trigger.
So you have a major reversal pattern on the weekly, confirmed by an intermediate continuation pattern on the daily, triggered by a minor breakout pattern on the 4-hour, all aligned bearishly. That has to be an exceptional probability setup.
It is 85% or higher.
Yeah.
The rule is simple. Only trade when at least 2 of the 3 time frames show patterns that are aligned in the same direction.
Beyond time frames, we also need to layer in other technical tools. This is pattern confluence.
Right, where geometry meets mathematics.
Yeah.
Confluence exponentially increases your success rates because you're triggering behavioral patterns and established mathematical levels at the same time. Take the head and shoulders again. If the neckline lines up exactly at the 61.8% Fibonacci retracement level of the prior uptrend, the success rate bumps from 78% up to 82%.
Why is that specific Fibonacci level, the 61.8, so powerful?
Fibonacci retracement levels are based on the golden ratio, and they're often self-fulfilling prophecy points where institutional algorithms are programmed to take profit or reverse positions. The 61.8 level is the mathematical sweet spot for a deep but healthy retracement. So if the behavioral failure point, the neckline, coincides with that mathematical exhaustion point, it provides dual confirmation.
And similarly, if patterns form at major support and resistance levels,
their reliability skyrockets. Yes. Patterns at yearly highs or lows, at the 200-day moving average, or at massive psychological round numbers like 100 or 1,000, they're significantly more reliable. A bull flag forming right off the 200-day MA can have a success rate up to 87%.
Because everyone is watching those levels.
All market participants, regardless of their strategy, they hold massive institutional weight.
This systematic grading ensures we're only taking the absolute best setups, but we have to address the reality that 25 to 30% of breakouts do fail. How do professionals recognize a false breakout? And more importantly, how do they trade it?
You have to recognize the warning signs immediately. The biggest one we've already stressed: a low volume breakout. It has a 68% failure rate. No conviction. Another critical warning is the wick through, close inside.
Explain that one visually.
Okay, so if the price breaks the pattern boundary dramatically during the candle, creating a long wick below support, but then it manages to close the candle back inside the pattern structure, that aggressive rejection signals an 81% failure rate for the original breakout.
It was a liquidity grab, not a real move.
Exactly. So those are your exit signals for a failed trade. But the source introduces the concept of the false breakout trade. This is turning a failed setup to a high probability entry in the opposite direction.
So you can actually trade the failure.
You can. This is pure institutional counter trading logic. When a pattern breaks out falsely, traps the early aggressive traders, and then price reverses quickly back inside the pattern, and volume surges dramatically on that reversal, it signals a powerful move in the opposite direction.
Why does the volume surge when the price reverses back inside?
Because the traders who were trapped on the wrong side, the amateur breakout buyers, are forced to cover their losing positions. Their selling or buying adds enormous sudden momentum to the actual move. This contrarian setup boasts a 72% success rate when volume confirms that reversal. You're basically using the failure of the amateur trader to fuel the professional's profit.
That is a highly sophisticated technique.
It is. Okay, so let's quickly review the 7 common pattern recognition mistakes that professionals relentlessly avoid. They are simple, but they're deadly.
Number 1, forcing patterns that aren't there. If you have to squint to see it, it's not a valid pattern.
Number 2, ignoring volume confirmation. That huge 20-point drop in success is a cost no professional accepts.
Number 3, trading against the higher time frame trend. Always check your weekly and daily chart bias.
Number 4, premature entries before confirmation. Waiting for that decisive candle close gives you a much higher probability of success. Patience pays.
Number 5, using arbitrary stop losses. Stops must be structure-based, period.
Number 6, ignoring failed patterns. Define your failure conditions before you enter and get out immediately when they're met. No hope.
And number 7, no multi-timeframe analysis. Relying on a single time frame is flying blind. You have to seek confluence. Knowledge is nothing without execution discipline. To truly internalize these rules, we have 2 detailed professional case studies. They show how this grading system, volume analysis, and discipline are applied in the fire of the real market.
Let's start with case study 1. Sarah's head and shoulders trade on XYZ stock. This took place in late 2024 on a high-flying tech stock that had topped out.
The pre-trade context was crucial for Sarah. XYZ had rallied hard, from $30 to $60 over 9 months. Her contextual analysis immediately flagged it as due for exhaustion. She saw the RSI was consistently overbought and she had bearish MACD divergence.
Meaning price was making new highs, but momentum was falling, so she was actively searching for a reversal pattern.
And the pattern formation was textbook. It was an A-grade setup specifically because of that volume profile.
It really was. The left shoulder had heavy institutional volume, about 650,000 shares. The head rallied on distinctly lower volume, 520,000 shares. And the right shoulder, that final feeble push, saw only 380,000 shares.
That's a 42% total volume decline from the first shoulder to the last. That perfectly confirms buyer exhaustion.
So the neckline was at $54.75. Sarah demonstrated true discipline by waiting for the confirmed close below that neckline. She had her volume rule checklist ready. The breakout day volume was 890,000 shares, 2.3 times the average consolidation volume. It confirmed the breakdown was legit.
And she used a conservative entry, shorting the next morning at $54. But the stop placement is the critical risk management lesson here.
She placed her structural stop at $61.50, just above the right shoulder high of $61.20, including a small ATR buffer for noise. Her risk per share was $7.50. Now, had she placed her stop above the head, her risk would have been almost $10 a share. By using the structural stop above the shoulder, the actual point of failure, she saved over $2 a share on risk.
Which allowed her to take a slightly larger position size while staying within her risk limit.
Exactly. And the profit targets were based precisely on the measured move. The head was at $63.80, the neckline at $54.75, a $9.05 range. Projected downward, the target was $45.70. a clear, objective goal.
And during the trade management phase, she demonstrated perfect execution, especially during the emotional trigger of the retest.
Yeah, 2 weeks in, the price pulled back to retest that broken neckline at $54.50. The novice traders often panic here, but Sarah checked her volume rule number 4. The volume on that pullback was low, only 320,000 shares. It was a healthy, low-volume retest. So she held firm, confident in the data.
And she scaled out.
She scaled out 50% when it broke through $50, locking in profit and immediately moving her stop on the rest to break even. Risk eliminated.
And the final result?
It showcases the pattern's precision. The measured move targeted $45.70, and she exited the final half at $45.80. She captured the full predictive power of the pattern.
Our second case study focuses on continuation in a fast-moving market. Marcus's bull flag trade on UAUSD in the Forex market.
Right. Marcus specializes in joining established momentum. His contextual analysis was based on the ADX indicator, which was reading 38. That confirmed a robust trending environment on the higher time frame. So that immediately elevated the reliability of the bull flag he was tracking on the 4-hour chart to an A-grade setup.
Tell us about the flagpole and the volume profile. Was it textbook?
Absolutely. The flagpole was a strong 240-pip rally over 2 days. During the consolidation, the volume reduction was exactly what we require, a 35% reduction. The consolidation itself was ideal, quick and tight.
Strong trend, low consolidation volume. Perfect.
The breakout came with a definitive 72% volume surge, satisfying our confirmation rules. Marcus entered long at 1.1150. He used a tight structure-based stop of 75 pips, placed just below the flag's lower boundary. Even on this A-grade trade, he only risked about 1% of his account.
And how did he manage risk during the trade?
Crucially, within 3 days, the price had moved 70 pips in his favor, and Marcus immediately moved his stop to break even, eliminating all risk. He scaled out the first half near a key target, locking in profit.
And he captured the rest of the measured move using a trailing stop.
Yes, the flagpole projected a 240-pip move. By using a trailing stop, he was stopped out on the second half at 1.1340, capturing 190 pips on that half. The trade achieved a strong 2.15 to 1 risk-reward ratio. It just confirms the power of the flag when you align it with a strong trend, strict volume confirmation, and unwavering discipline.
These case studies perfectly illustrate the 5 critical truths we've discussed today.
They do. First, quality. Not all patterns are equal. You have to grade them. Second, volume. It is the heartbeat, the institutional conviction. Ignore it, and you drop your success rate by 20 points.
Third, context. The same pattern has vastly different success rates depending on the trend and the time frame.
Fourth, confluence. Aligning patterns with technical levels like Fibonacci or support and resistance multiplies your probability. And fifth, discipline. Knowledge means absolutely nothing without the discipline to execute your plan precisely.
So what are the next steps for you, the learner, to move into this professional tier of trading in 2026?
The path is pretty clear and structured. You have to move past passive learning and into active system creation. Start by mastering just 3 to 5 core patterns. I'd recommend HNS, double top bottom, and the flag pennant.
And then immediately create that objective A, B, C grade checklist for each pattern.
Integrating those 4 specific volume rules, that checklist is what removes emotion from your analysis. It's what ensures you only take A-grade setups.
And you have to verify your system before risking a single dollar.
Backtest thoroughly, 100 or more historical examples. Then, paper trade for at least 3 months, following your rules exactly, confirming your discipline before you ever put real capital on the line.
And that brings us to our final thought for you to chew on as you move forward with this advanced arsenal.
The patterns themselves, head and shoulders, flags, triangles, they're not new. They've been recognized for over a century, since charts were literally drawn by hand on graph paper.
Right.
Your competitive advantage in today's algorithmic market isn't in discovering some novel formation. Your edge is solely in correctly grading the quality of the known formation, confirming the underlying conviction using volume, aligning it with high time frame context, and then executing with unwavering discipline. That is how institutional traders view market structure. And now, equipped with this professional, updated framework, so can you.
That's all for this deep dive. We'll talk to you next time.